Okay, we're going to do a follow-up to yesterday's video. These are updates, more information, more details. Definitely got a lot of questions on Discord from people PMing me. I try to answer all of them, including from the low complication of how do I buy a stock all the way up to how long do we have to wait, which is incredibly complicated. But I want to give more information about how this all works. What are the different ways of shorts that people are talking about, like the expirations or not expirations. Some do expire, some don't expire. The possible outs for the people who are holding these short positions. Going to talk about Reg T minimum margin requirement, what that means, how it impacts what we're doing and how we're squeezing. We're going to talk about FINRA. We're going to talk about quite a lot of stuff. Now, the first thing I'm going to cover is the real basics, though. I want you guys to understand exactly what a shorting a stock is. I want to talk about calls. I want to talk about puts in like a real simple way. I'll give some examples. Lastly, I divided this video into two parts because it was just too long. The first part's going to be about shorts. Second part's going to be about puts and calls and options and the risks. So let's get started. All right, so first things first, is stuff expiring or is it not expiring? Now the answer is both. There's two ways to short a stock. The first one is short selling. Now what that means is I borrow a share from some lender and then I immediately sell it on the market. But the difference is I don't actually pay for the full share. I said I borrowed it, and borrowing means I'm borrowing with some percentage as margin. So I'm keeping some amount, like I have 25% in my bank account that the lender knows exists. So if when the time comes that I need to buy, I show that I am capable of buying some shares. To be clear though, legally speaking, these shares have to exist. Basically, the lenders have to own those shares in order to lend them to me. But that's not exactly what's happening. So this is called naked shorting. Now, naked shorting, again, is an illegal practice of short selling shares without actually having that share exist. Now, how else could the short percent go up to 140% unless people are literally making shares out of thin air? So even this page says, look, it's completely legal what they're doing, but it happens all the time anyway. Thing is here, you are required to keep a minimum balance in your account at all times, given the FINRA requirements that are laid out. Now, FINRA is the Financial Industry Regulatory Authority. If you go to the about, they were actually guaranteed by Congress to protect America's investors. So this is something that's more of a government organization. I don't know too much about it, but essentially there are requirements that are very strict that the investment firms, the hedge funds, have to follow based off of being a FINRA member. That amount is 25%. The amount here depends on when you're buying and when you're holding. There's two different types. When you're buying on margin, you have a set initial margin and maintenance margin. So two different types of margin. Now these are by law. Initial margin must be 50%. That means you must have at least 50% of the total cost of what you're purchasing in your bank account at the time of purchase. And additionally, when the stock, for example, goes up and you are now owing more money, because if you shorted the stock, you eventually do have to buy that stock, remember. And so if the price goes up, you have to increase the amount of balance that you have in your bank account by a certain amount every time it goes up. This is called the maintenance margin. It's a 25% rate. If, for example, we have a stock at $100 and Melvin, hedge fund, short sells 1,000 of that stocks, that price using a minimum margin of 25%, then that means he must have at least 25K in the bank. Now he must have had at least 50K in the bank to start, but then you can actually just take it out. I don't see, there's really no, to have an additional margin and be different than the maintenance margin really makes no sense. But then that also means that when the stock goes up, so say for example, the stock raises to $200, Melvin hedge fund must have an additional 25K, a total of 50K in the bank at that time. If he doesn't, what happens is you have margin calls and your lender essentially forces you because they have access to your funds. So the main thing here is this actually increases at a 1-to-1 ratio. You know, you think when you buy on margin, your losses go up by X percent based off of the margin percent, which is true. But in this case, what we're talking about when we're squeezing, the main concern here is like, how long does the squeeze need to go on? Well, if the squeeze, if they can maintain at least the minimum 25%, and some lenders require more or less, but usually with these big firms, they're getting the minimum. As long as they can maintain that balance, then they're okay. You eventually owe the full amount, right? You eventually have to settle at some point. And so lenders can get nervous. For example, although you only need to have in your account 50K, you really owe 200K. If your company is worth a certain amount and you've lost or owe more than what your company is worth, your lender's definitely gonna get nervous, and that can also cause some squeezes to happen. Although I will say that it's pretty rare for lenders to force close positions. So this is why in our Wall Street's Bets squeeze project that we put together, we had our page that said who owns this stuff. That's really important because for squeezing, it's very difficult to squeeze, for example, someone who has $520 billion in capital, because the lender's not really going to get nervous if, for example, their required margin goes up only by like a percentage of their complete value. Whereas with Melvin Capital, they already owed their entire worth plus. So of course their lender is going to get very nervous, which is why they required capital infusion to make them more liquid so that their lender wouldn't get nervous and force them to close their position. Now, the good news is, though, that this percentage of shares is actually fairly small. So it's a very diverse group that's holding shorts. Basically, we don't have to squeeze just the biggest guy. We can kind of squeeze across the board, and just some of them need to fall, and then that'll cause lenders to get nervous and start closing positions, which will cause other lenders to get nervous and close positions, and you'll have this kind of domino effect. So again, that brings us to the question, how long do we have to wait? And this is only for short selling. I haven't even got to the options part yet. But the answer for short selling is kind of unknown. Basically, we have to see if the stock price goes up very quickly, very fast, that'll make it much shorter duration. If it goes up slower and the lenders kind of like want to wait it out, it's going to take a lot longer. As I've already talked for 6 fucking minutes and given a ton of information, but haven't even given you like an action item yet. But to reiterate, you set a limit sell order for a very high amount. Say, for example, $1,000 if you're GME, maybe 100 or 200 if you're AMC. And what's going to happen is eventually people will be forced to buy on the market because their lender's forcing them to buy at market price. And if there's no shares available because we have purchased them all out of the free market, and we do not sell, that is very important because increased volume allows them to do high frequency trading where they dip down the price, they buy a bunch, then the price goes back up, and then people get excited and they buy it. And basically the high frequency traders are definitely going to win over us because we just don't have the sophistication that the high frequency traders have when there's high volatility, high velocity, and the price is going up and down. The best thing to do is to not try to buy and sell because that's screwing us over. It is to just buy and hold and set a high sell order. Very high. So I'll have my sell limits here. This is probably what I'll be putting. You can go higher, you can go a little lower. The advantage of going higher is that if, for example, the stock market does dry up and the people are forced to buy at market, honestly, the sky is the limit. You may hit 10K, you may hit 100K for one share. I will be changing these as I kind of view the market and how successful or unsuccessful the squeeze is going. I also want to, before we move on to the puts and the calls, I want to first get a quick glance at how things are going. Right now, if we look at GME first, you'll see that according to Ortex, and again, I want to keep in mind that these are estimates, right? Nobody really knows, to the best of my knowledge, nobody actually knows what the real free float on loan is. Different Twitter posts have said it's over 100 still. Some sources show even higher. Some sources report a little lower. This one's reporting currently a 38 million estimated short interest. And again, the total stocks in GME, if we look at Yahoo Finance, you'll see the total float is 46. So if you take the 38 divided by 46, you get an 82%. So here we can take a look. Now, it depends if you trust this source or not. There are many, many sources of what the short interest is, and here where it says short interest, usually short interest is a integer number, not a percentage, which means how many stocks are shorted. But in this case, they're just dividing it over the float for you already. So this is really short interest divided by float. It's a little mislabeled, but they're still saying it's 121 for GameStop. They're saying it's 78.97 for AMC. Different sources will say different things. If you go to Yahoo, again, it shows a 38.12 0.12 short percent of float, but this is on January 15th, and we have seen signals that the AMC shorts are continuing to be bought. But if you look at Ortex, you'll actually see that the GameStop free float on loan went way down. So they believe, according to their estimates, and again, these are all estimated, you can even see it says estimated short interest. Their estimates are actually that people are covering their shorts right now, as in like the squeeze is happening essentially now. And that doesn't mean to sell at the current price. 60%, even if it is 60%, is still extremely high, and I'll tell you why. All right, so this is where I break. We're going to tell you why 60% is not a big deal. Things don't have to be 100% in the next video. Again, we're also going to talk about puts, why those are important in squeezes, and we're also going to talk about risks. So check in part 2 for that stuff.